Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name is Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Our guest this week is none other than Katie Stockton. Katie is the founder of Fairlead Strategies and the portfolio manager of the TACK ETF. You've probably seen her on CNBC. She's one of the most respected technicians out there, so it's going to be a good one for sure. But before we talk to Katie, it's Friday, the markets are closed, so let's take a quick look at how this week played out. All right, so it was a pretty bullish week. All four major indices closed higher. The Nasdaq led, gaining nearly 5%, marking its best week since November, and the fourth consecutive week higher. So the Nasdaq's off to a great start in 2023. The Dow lagged, but it still closed the week higher by about 1.8%. Now, taking a closer look at the S&P 500, we officially reclaimed the 200-day moving average and that notorious downtrend line this week. So pretty constructive action, but that 4,100 level is going to be an important test next week. It was resistance back in September and December, and the VWAP from the peak is also sitting right around that level. So keep an eye on that one next week. Taking a quick look at the sector performance, 9 of the 11 sectors closed higher. Consumer discretionary led, gaining about 6.4%. Healthcare was the laggard, falling a little less than 1%. Anyway, that's enough from me. Let's welcome Katie onto the show. All right, Katie, welcome onto the show. It's great to see you, and thank you for joining us.
Thanks so much for having me. Good to be with you.
Yeah, of course. I've been a big fan of your work for years. You're the founder and managing partner at Fairlead Strategies. So could you just tell us a little bit more about Fairlead?
Yeah, for sure. So I founded Fairlead in 2018 after a very long career on Wall Street publishing technical strategy research. And Fairlead Strategies is both an independent research provider, so we offer research via subscription, sort of a consultant, a technical consultant, and also now an ETF portfolio manager. We focus primarily on U.S. equities, but we do a lot of work on anything related to that, meaning, treasury yields and crude oil and gold, you name it. We have regular coverage of all of the above. And our discipline is all technical all the time. So we have a toolbox which consists primarily of technical indicators representing momentum, overbought, oversold readings, relative strength, and we always have an eye towards the levels on the charts. So we spend a lot of time during the day just watching the market and trying to evaluate these levels.
Yeah, and you mentioned it, your ETF, the ticker symbol is TACK, T-A-C-K, and you launched it last year, if that's correct. So could you tell us a little bit more about the methodology behind it?
Right. Yeah. So it's called the Fairlead Tactical Sector ETF, and that part's important, the sector part. We first start with 8 buckets to fill, and these are equal weighted buckets. And ideally, in a bull market, we'll fill them with sector spider ETFs. So it's essentially a fund to fund or ETF of ETFs that's focused on sector rotation. So we're trying to fill the buckets with the best sectors in terms of momentum, overbought, oversold readings, and also relative strength. Of course, the market doesn't always lend itself to that. So we're also trying to protect on the downside. So when we have a loss of long-term upside momentum behind these sectors, that's meaningful. We essentially swap them out with risk-off categories, also via ETFs. Those categories represent short-term treasuries, long-term treasuries, and gold. And we combine those for a diversified way to manage risk, essentially in either a trading range environment or a bear market environment, of which, of course, we launched the TACK ETF. We launched the ETF in March of 22, and we're happy to say it outperformed very nicely last year, kind of proved itself in a challenging environment in terms of limiting the downside and also doing so with less volatility. And we look forward to seeing it get into more of a risk-off posture here in the coming months, hopefully. But that obviously will require a more established bull market move.
Yeah, I mean, I think it's a great idea. And, I don't know if you can comment on this or not, but I see a little inverse head and shoulders forming there, and we wish you the best of luck with it.
Thanks so
And
much.
not to mention, what a tough year to launch an ETF in last year, and tough time too. But let's get right into it. We have a ton of charts to cover. I want to kick it off with the S&P 500. We're recording this on Thursday, January 26th. We're off to a solid start in the year. And, Katie, whenever I see your charts, I often see the Ichimoku cloud on there. And that's one thing I like about your style is you use some of the indicators that we're not all looking at. Like I know you look at DeMark a lot and the Ichimoku cloud. And I got to tell you, I really don't look at the Ichimoku cloud too much. I'm not too familiar with it. So could you explain to us a little bit more about how you use it on, say, a chart of the S&P 500?
Well, we are adhering to it on a regular basis for sure, as both an indication of where there might be support or resistance on a chart, and then also the prevailing trend over different time frames. So very simply, when the cloud itself, which is derived not from moving averages, which is sort of a typical trend following gauge, but rather midpoints of price. So we get this kind of interesting look to it where it plateaus at times. Based on these midpoints of price and some sort of derivations thereof, we get this shaded area on the chart with the forward-looking projection. And that forward-looking projection gives you a sense of, again, the prevailing trend looking forward, and also potentially where you might see support discovery or resistance met. And we do look at it on multiple time frames, which is the case for all of our indicators and tools. We're looking at them on dailies and weeklies and monthlies, and they'll often tell completely different stories over those time frames. So it's always very important to understand what time frame you're focused on at that time in terms of imparting your views. And the cloud model right now for the S&P 500, if you look at it on a weekly bar, it still suggests that the bear market cycle has its hold. So the bottom boundary of the cloud, which is essentially like an initial resistance level, becomes the sort of first hurdle on the chart. And then the second hurdle would be the upper boundary. A strengthening trend, meaning a downtrend that's sort of losing steam, should actually get into the cloud itself. It should be able to surmount the lower boundary and get closer to the higher boundary as part of a process, a reversal process. Right now, we're right at that lower boundary testing it. So we're watching that very closely alongside our other indicators.
Interesting. And it's a moving average based indicator, right?
It's actually not based on moving averages, but it's pretty similar to that. It's looking at midpoints. So it's taking a high-low range over time and actually just taking the midpoint of that range and projecting it in various ways forward. It's a little bit of a complex sort of construction, but the takeaway is actually quite simple. It's a very easy visual. In fact, I think Ichimoku, don't quote me on this, but means one look in Japanese. So it's trying to provide just sort of one complete picture of that prevailing trend and support and resistance, which when we're looking at charts, that's our first charge, is to really determine the most important levels to source going forward.
That's very cool. I think, like I said, very unique that you do use that indicator. And if I remember from the CMT exam correctly, again, might have this wrong, but I think it was created by a journalist in Japan back in the day. Can't remember, but anyway, another development that's been getting a ton of coverage lately has been this improvement in breadth, right? As we've seen this rally off the October lows, these last couple weeks, you're starting to hear the word breadth thrust tossed around a lot. And I know a lot of your work incorporates breadth. So what's your take on breadth right now? And what are some of the breadth metrics that you're watching right now?
Well, we watch actually a lot of breadth metrics. In fact, in our morning note, we publish, I think, maybe 5 or 6 of them on a regular basis, and they're all on our radar any given day. Some have very short-term implications, some have very longer-term ones, but we have them all on our radar. But I will say, to frame sort of breadth in the bigger methodology, it's not the first thing that we go to for market timing. We do pay attention for the most part when breadth measures are at extremes or have some kind of divergence or breakout or breakdown. So that's when we pay attention. Otherwise, we kind of ignore it. But of course, we did have some extremes recently in terms of expanding breadth on the upside. And as you mentioned, it's very widely publicized out there that there's been so-called breadth thrusts. There's a lot of ways to measure that. Everybody sort of has their own tools and indicators. It's not a term of mine, but certainly if you look at any of the breadth measures, they've run up pretty strongly over the past few weeks. And actually, we've seen some contraction since last week, but even still, those so-called thrusts are still in place. And then it's a matter of how to evaluate them. And we've seen several breadth thrusts throughout the bear market cycle, and they're not uncommon during these relief rallies, which during bear markets tend to be really fast and furious. If we were to see something that was a little bit more less like a thrust and more like a slow grind higher, that would actually be more intriguing to us, in that we want to see breadth expanding, but in a sustainable way. If you look at something like the McClellan oscillator, which is one measure of breadth that we track, you'll see that it got quite overbought in just the past 2 weeks or so. And it often, the peaks in that measure tend to precede peaks in the S&P 500. So we're a little bit nervous about the implications of that breadth peak short term, but longer term, the breadth thrusts do occur around sort of the earlier stages of bullish reversals. So we're going to be hopeful, like everyone else, that that's perhaps one indication of that. But we just don't have sort of the proof points on our long-term charts yet. We're looking at long-term indicators to try to understand if an important low is in place already, and we're not going to go to breadth to source that.
I see. So it's kind of a secondary input. And I like what you said there about how there's a lot of different ways to quantify a breadth thrust. And like you said, we heard it's kind of like the boy who cried wolf. I mean, you had everyone talking about breadth thrusts in March of last year, and then again in August. And of course, the index went on to make new lows, right? So
Right.
I understand why it's a little hard to trust those improvements.
That's right,
But
especially if you're not also seeing it alongside the improved momentum that's meaningful. That to me is a bigger requirement for a turnaround, is that more decisive improvement in momentum.
And I'm not sure how much you incorporate like sentiment into your work, but what's kind of your read on that? Or do you think it's kind of just a wash right now and kind of hard to read? Because it does seem kind of hard to identify how the crowd is actually feeling right now.
Yeah, it is tough to measure, and there's, again, like breath, a lot of ways to measure it. So I think the key is just going back to the same tools and just letting them inform your biases in a systematic fashion. We like to watch the VIX, or volatility index, for one. It does show some complacency near some long-term support here. So we're going to continue to watch that to see once it starts to turn the corner. Of course, that would be a risk metric for the equity market. We see it more from that kind of contrarian perspective. We want the market to be a little bit more, it doesn't need to be extreme fear, but the stuff that we're seeing month to date in terms of market sentiment, it just seems like it's a bit too ambitious based on where we've come from in terms of the readings on the VIX.
Yeah, it does. It does seem like people have really embraced this rally. And you mentioned the VIX. What do you think of that? Are you looking for kind of a capitulative move? Because one thing everyone was talking about last year was, throughout this really hard bear market, we never really broke above 36, 37 on the VIX. I mean, typically for an end of a bear, you'd want to see kind of a capitulative move. Is that right?
Yeah, I mean, I think you said it, right? So if we just refer back to past bear market cycles, they have needed a VIX reading of 48 plus typically. So it doesn't mean it's a guarantee that we're not out of the woods yet, but it would suggest that we haven't gotten to that place that is the normal reading over history for the VIX. So we don't have any way to know what could drive that sort of volatility event or anything like that. But certainly if the VIX starts appearing to turn the corner, that's when we would position for it, if not already. We just want to make sure that the VIX is, staying depressed if we have this sort of bullish bias, right? So for folks who are exposed on a counter trend move, I would say as long as the VIX is below the 50-day, they're a little bit safer. But as soon as the VIX can clear that 50-day moving average, that to me would be indicative of a potential move up that could be significant in the VIX.
Yeah, I think that's a great point. So I want to move on to the communication sector because I think it's really interesting. Here it is, the best performing sector by a decent margin. I know we're only less than 1 month into the new year, but it's up about 14% so far year to date, and January's not even over yet. On the other hand, it's down like 37% from its highs. It was the worst performing sector last year. So quite a change of character in these first few weeks of the new year. So do you think communications have found a bottom, and are you watching any of the two largest components in there, which are of course Alphabet and Meta?
Yeah, I mean, it seems to be a manifestation of that sentiment, right? Where folks are looking for value, and they feel that because this downtrend has been in place for a long time for communication services, that perhaps they're able to find some value there. And I think that that's in part why the run up and why the outperformance. Now, in a shift back to risk off, you would expect that to be retraced to some degree. I think there's the chance that we have an important low already in place for communication services and for the sort of small and mid cap, sort of high growth types of names, many of which had been downtrending since early 21. And yet, I think it's early to be convinced that this is sort of it's out of the woods, and that I think we usually tend to see a retest, and often a very hard retest of that initial support level. So rather than, looking at XLC and saying, okay, well, we have this breakout and it's time to add exposure, I think we can, confidently say that the pullback will probably provide a better entry point. But that the initial move off the low is impressive, and it does impact the longer term gauges in a way that's somewhat promising. They're just not far along enough to suggest that we have a final sort of base in place, and that the market's ready to go. We did move in our work from an underweight bias to an equal weight bias recently for the sector, sort of ahead of this oversold bounce, because we're expecting more stabilization in relative terms. But we're not convinced that we have immediate upside follow through in either versus the S&P 500 or in absolute terms, in part because of our DeMark indicators. So we use those to understand if something's perhaps exhausted one way or the other. And right now we have brand new, actually, signs of short-term upside exhaustion for XLC, both on the price chart and then also on the relative strength chart versus the S&P. So we want to heed those signals as being indicative of a pullback and something that we would wait for before looking to add exposure, if not already. The Meta and the Alphabet charts are certainly sort of aligned with that, where they have downtrends in place and significant relief rallies. But there too, I think to assert or reassert a long-term position is probably better done after a pullback at a very minimum. And in my preference, to see even more improvement or support discovery that impacts the longer term indicators in a way that it just hasn't done quite yet.
Yeah, I mean, I think Meta is at a really interesting spot. I mean, here it is up more than 65% from its lows. I mean, that's been a sharp rebound in less than 3 months. But it's still down more than 60% from its highs. So, a lot of work to do for
And
some of
that's
those
one of
beaten down
those violent
communications.
relief rallies, right? We would
Right.
be almost more encouraged by something that was a bit more orderly than a 1 month move of that nature.
Yeah. So let's move away from stocks for a second, and I want to talk about natural gas. I gotta admit, I don't really look at Nat Gas too much, mostly just because it's such a wild animal. A lot of the traders I talk to, they call it the Widowmaker futures contract for obvious reasons. I mean, it's just so volatile, and a lot of them just haven't had luck with it. Anyway, it's fallen like a knife lately. by far the worst commodity, sorry, year to date. But you put a trade idea out on Wednesday. So what are you seeing on the chart of Nat Gas, and why do you think it might be worth a shot on the long side here?
Yeah, and by it's a short-term recommendation. So to be clear, we're not saying we necessarily have a long-term entry for natural gas, but the downtrend, which of course is very pronounced, is showing some signs of downside exhaustion per those same DeMark indicators. And we had a similar signal that we got in the past couple of days, just at a previous low. And on the sell side, we had one at the ultimate high. So I think that these signals have been timely enough to at least dictate some attention and, at least call for an oversold bounce, some temporary relief to that downside momentum that it has exhibited. But as a counter trend position, it holds just inherently more risk than a position that would be in the direction of the prevailing trend. So with that in mind, we always have, when we publish new ideas, we have a Substack newsletter that we do that through. When we do that, we make sure to have defined risk reward metrics to kind of take some of the emotions out of a position and make sure that we're on the right side of things and don't get caught up, with a breakdown or something of that nature. So tight stop loss on any counter trend positions, but we do think it's poised for a bounce, something that could actually be significant just in terms of the room to the initial resistance levels that are out there.
Yeah, and I'll reiterate it's kind of just a short-term mean reversion trade that you're looking for. Maybe back to the 50-day as your first target.
That's right. The 50-day moving average is often a great gauge of resistance or support, and also a nice gauge of the sort of prevailing intermediate term trend, which of course is still lower. So.
Yeah, and of course, in technical analysis kindergarten, they teach you don't try to catch a falling knife, and I just called this a falling knife. But I think, the risk and reward is obnoxiously skewed kind of thing. And as long as have your stop in, where your out is, I think it's probably worth a shot. So I don't think it's a crazy idea to
Yeah,
catch
and
that knife.
that's always the key, is to have, if you have conviction, and you can define a stop loss, I think you know what your risk is. And we always like to look at stop losses on a consecutive closing basis. So if you see a couple of closes below, that would be a stop loss trigger for us. But everybody has their own sort of risk tolerance, right? So it could be a percentage-based stop loss, whatever it may be. But that's protection. And that's something that the charts are great for, helping us discern what's a key level to use, or do we have the indicators on our side, or is this a counter trend position? Is it worth it? Is there enough room to the next resistance? And that kind of input can be really valuable, especially if you combine it with anything fundamental or macro oriented to further support the position.
And let me ask you about that. In your process, do you include any of that stuff in there? Like, do you include news or Fed commentary, things like that?
No, I mean, it's really not our area of expertise. We obviously consume a lot of it just like anyone else does. So we're not sort of ignorant to the news. We're not ignorant to the earnings report states and things of that nature. But we really do try to be purists in how we're approaching our analysis. We base it solely on our methodology and solely based on price. So we really focus on the charts themselves. And ideally, there is a sort of a base case for whatever we're seeing from either a fundamental or macro perspective. And it happens often because there are drivers of these trends, right? So, if you see a stock that's trending to a certain level and seems to meet resistance there, well, maybe that's a fair valuation for the stock, or at least that's a perception from the marketplace. So there's reasons why these levels hold importance. The chart won't tell you those reasons, but they are out there, and I think that sort of taken together, it can be really powerful.
Well, that certainly resonates with me. I mean, we are purely technical here at the Chart Report as well, so I definitely agree with that. Anyway, I want to move on to another commodity. This one's been pretty hot lately, and it's gold. didn't have such a hot year last year, but here we are at 9-month highs. That long-term base is still intact, despite it not doing so great last year. And it really looks like we're trying to make another go at those former highs and that 2000 level. So let me ask you, what are you watching here on gold, and does it get you excited at all? Like, do you think it's worth a shot in terms of will it outperform, or do you think it's just a nice looking chart, or
So I
neither?
like anything that's not as correlated to the equity market right now. Gold over history has outperformed in more difficult equity market environments. And so that draws our attention to it from a relative strength perspective, especially last year. Even though last year gold spent much of the year trending lower, it really staged a nice turnaround. And that turnaround marked a reflection of a reaction to long-term oversold conditions. And that long-term oversold condition happened in more of like a range-bound environment as opposed to a downtrend, making a little bit higher probability than the oversold conditions that we have in downtrending securities. So we're encouraged by the upside follow through. We're watching pretty much the same level as you in terms of the upside room to that 2063 level on the commodity. And we're not seeing a lot of sell signals there. The gold is one of our choices for a risk off category in the ETF. So we hold shares of GLD, an ETF representing the price of gold, and we've sourced some outperformance there.
Yeah, and it kind of really this current leg higher on gold really kind of all started with that false breakdown below those 2021 lows, and that's something that I really like to see. So I think that long-term base on base, call it a cup and handle, whatever you want, it's totally still intact, and it'll be interesting to see what it does over the next 2 years. But anyway, I want to finish up with crypto, digital gold, if you want to call it. And I know your firm does a lot of work on crypto. So what do you think here? Do you think Bitcoin has found a bottom?
Well, I think it's too early to tell there as well. Just like the other sort of risk assets, we've seen a really strong relief rally month to date to start off this new year. And that does lead to some upticks that are somewhat promising, but just not even close to being a long-term buy signal. So we're going to defer to the prevailing downtrend, which we have based on some of our longer-term metrics, until we have something a bit more convincing in those long-term gauges. And then with the relief rally itself, what we just highlighted, in fact, today to our clients, which we have a weekly report that we publish on cryptocurrencies. What we highlighted though today was sort of a special report in that we have one of those DeMark signals following the relief rally. So we're paying attention to the signal because they've been pretty timely indicators of inflections in the past. And it would just suggest that the up move is stretched, and we're not willing to chase up moves in this environment, not until we have more of a basing phase or more sort of a convincing turnaround underway. So we're not convinced by Bitcoin. We wouldn't minimize where it's come from. It's been a very impressive relief rally. But for now, we think we'll see a bit of a risk-off move. And during that risk-off move, we can then judge whether we're seeing any kind of divergences unfold or, how are the altcoins trading. There's any number of factors that we can evaluate into that pullback. But we do expect a near-term pullback. And that then, of course, could prove to be one step closer towards the ultimate low.
Yeah, and I think that's a fantastic point you raised about how you'd like to see some basing, right? And I really think if you're a long-term Bitcoin bull here, the best thing you could see Bitcoin do in 2023 is build a nice base. And so that we could like launch higher in 2024, 2025. I think obviously this rally that we've seen off the lows is, I think we can both agree it's constructive, but the base that you want to see it form a base, right?
Yeah, and I know it's hard and frustrating for folks to, think about living through a basing phase because it means you have a choppy environment. It's tough to a sort of directional position and do well with it. We're so accustomed to corrective phases that end in this like dramatic V bottom fashion. but that doesn't tend to happen after a big bear market cycle. So a basing phase would probably be constructive, and at a very minimum, if we did already have a major low in place, then we would expect to see the momentum turn in a way that it hasn't quite yet. It almost hasn't really had a chance to yet, just because it's been such a fast and furious relief rally. So that's the kind of thing that we're always skeptical of. A so-called melt up, it's usually not wise to chase those.
Yeah, I would agree. And let me ask you also about its role as kind of an indication of risk on, risk off for the broader market, right? I mean, all last year, the NASDAQ and Bitcoin, I mean, they traded almost in lockstep. So do you look at it as kind of information for the broader market or risk appetite out there for
Yeah,
stocks?
by all means. I mean, it's pretty sort of high on the risk spectrum. So we do check it every morning, even to understand, sort of what's the appetite for risk that morning. I wouldn't say we're doing it really scientifically, but it certainly is something that can reflect risk appetite. We also see that in other areas of the global markets. I mean, even the meme stocks have perked up their heads this month. So, so whether that's good or bad, I would say I don't know. I'm not convinced it's good. Let's put it that way. But we do look at it for that, and I wouldn't expect it to hold such a strong correlation to the Nasdaq 100 this year. But we'll keep an eye on that as well.
Yeah, I mean, I think the worst thing you can do with this asset class is get too dogmatic, too religious about it. But I will say, I think it's really cool that we can take some of our technical toolbox and apply it to this new asset class that we're kind of all trying to figure out how to apply those tools to. And I think your firm is doing a great job of kind of, trailblazing that effort. So
Thank you.
kudos to that.
Yeah, I think it's a matter of taking some of the emotions out and just looking at it more from almost a mathematical perspective. What is the supply and demand right now for any given security, and that especially in a top-down oriented environment like we have here, it's just essential to have on your radar, just to have an understanding of that supply and demand.
Yeah, I mean, I'm sure you would agree. I don't understand how anyone else would trade these things on a short-term basis without technicals. But Katie, anyways, we got to wrap it up now. But thank you so much for joining us. It's always great to hear your perspective.
Of course. Thanks so much for having me.
All right, have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you next week.